Welcome to What's Your Pricing Strategy and Break-Even Point? Get confident and clear with what drives profit. It is a pleasure to be with you today. I am Coco Selman, five-time founder, impact investor, and creator of the Force for Good business system. And today we are diving into one of the most important topics of creating a business of substance and scale. And that is so that you discover and define what your pricing strategy is, along with knowing what your break-even point is. So let's dive in to this important topic. Let's see, I'm going to bring up some slides. And all right, so question for you. Are you generating plenty of revenue, but still not paying yourself nearly enough? Is this a problem that you're facing consistently? Are you confidently telling an investor or partner your break-even point? Could you ask any member of your leadership team, marketing team, or product team to explain your pricing model? If you are unable to answer those questions with clear confidence, today is a great day for you to step into this conversation about pricing and how it can impact the success of your company. So, what is a pricing strategy? Pricing strategy is your method for setting prices for your products and services. And the idea here is that we aim for three things. First, profitability. Second, market share. And third, customer satisfaction. So it's a blend of those things. The second thing we're talking about today, and it is deeply connected to your pricing strategy because you want to get to this point and then go beyond it. And that is your break-even point. The break-even point is when a business's total revenues equal its total costs. And it results in the moment where you are at break even. You're no longer in the red. You are now at zero. And now every single time you sell another product or service, that profit, that actually revenue goes straight to the bottom line. So we think about it in this context. We don't think about it in terms of total loss and total revenues and total cost. We think about it in terms of gross profit and operations expenses. That's when those two things come together and are the same. That's when you hit break even. So it's important to know at any moment how many products or services you need to sell to break even on a given month, even a given week, certainly in a given year. And that helps you to be able to manage and see quickly where you are and where you are above that amount. And every time you start to sell another product or service and you sell that unit again, then you know in your mind and in your team's mind, you start to think about what your profitability really looks like. So let's dive into pricing strategy a little bit more. So again, it's this blend of profit, customer satisfaction, and market share. The goal is to identify the optimal price for each of your products and services. So the optimal price balancing revenue, demand, and competition. So you could certainly get to break even faster if you set your price higher, but does that mean that you will put yourself in a awkward competitive situation? You don't want to be totally overpriced unless you have a reason to do that. You also want to include in your thinking the production costs, the competition, market conditions, the positioning of your brand. Are you positioned as the really exclusive top end player with very bespoke services, or are you positioning yourself more as the get it up and running fast and it's simple and easy and a lower cost solution? So your positioning matters when it comes to strategy for your pricing. and also your perceived value. So, what I invite you to step into today is this idea that you can price with absolute clarity, not apology. So, knowing where you're coming from and how you're pricing so you don't feel any sense of ambivalence. So, pricing strategy is a thoughtful way to create profit. So, profit is the fuel of every successful business. We know this. Profit fuels purpose, growth, and prosperity. And so sometimes early on, we get ourselves in this situation where we price ourselves low in order to get more sales, but then the revenue isn't producing enough profit. And we have to sell in order to achieve break even and beyond and prosperity. So the right pricing strategy funds the future you and your company are meant to actualize. So there's some definitions we want to make sure you know about as we dive into this conversation. First, price. Simply, it's the amount of money you charge for a product or service. We usually think about this as a per unit price. We also talk about revenue. So revenue is the total amount of money a company receives from its activities, primarily through the sales of goods and services. And this is before any expenses are extracted. It is often referred to as the top line because it appears at the top of your income statement. We're going to get to your income statement in a few minutes. Next is the cost of goods sold. So cost of goods sold is the cost for making, acquiring, producing, or delivering your services. So this is the part where you're saying, okay, well, here's my product and here's what I pay for, what I'm charging for it, the revenue. So the cost per unit times however many units I sell is my revenue. And then my COGS, this is how much it costs to produce it. But it doesn't include all my operating expenses, which are things like utilities and rent and Wi-Fi and printers and etc., right? So it's this piece up here, and whatever the delta is between your revenue and your cost for producing the product or service, that is your gross profit. Gross profit is an incredibly important number for you to be aware of. Hopefully your gross profit is well below or it is competitive to your competitors, right? So that you have a benchmark for what others' costs are for cost of goods sold. And sometimes it's about having a plan to reduce that cost over time as you start to produce more and more and more of your units sold. So gross profit is calculated by subtracting the cost of goods sold from revenue. And so then you have your gross profit margin percentage. And this is the percent of revenue that exceeds the cost of goods sold. It's calculated by dividing gross profit by revenue and expressed as a percentage. So it's your gross profit margin percent. And we like to look at that and compare it as a baseline to other companies in your same market. And it'll give you a sense of whether or not you are balanced and on track. And then it'll help you develop your pricing strategy. So there's many different ways to think about how you might price, right? And so there's cost plus pricing. And this is where you add a markup to all of your production costs, where you come up with a particular percentage above the price or the cost of production. That's a mechanism. Some do that. Certainly with retail items, a lot of times there's a particular markup that you stick to. Value-based pricing is where you have prices based on customers' perceived value. Competitive pricing is pricing in line with competitors. Where you have another is where you have penetration pricing. So you start with a lower initial price to enter the market, and then over time you find ways to expand. And lots of companies do that. Introduce first 100 customers get this introductory offer kind of thing, and then the price goes up over time. Premium pricing, so high price for high quality or exclusive products. So you might have some low barrier to entry products that are priced a particular way, and then you have your premium products that you spend a lot more time and energy and focus on, and those might have a much higher gross profit or gross profit margin, percent margin. So you want to think about how you want to position your prices for each of your products and make sure that you are thoughtful about it. So make sure your pricing, and this seems obvious, but it isn't always, both profitable on a long-term basis and competitive so that the price sits well with your authentic customers relative to the market that exists out there. So the next topic here, break even, before we go into the tool of the week. Break even is the total was where your total revenues equals your total costs. And so when you think about total costs, it's really your COGS, your cost of goods sold, and your operational expenses. And so rather than just try to add COGS and operational expenses up all the time, break even we think of as just, it's that moment on your income statement where gross profit is equal to operations. And break even point is when the business's gross profit equals operations expenses, resulting in no profit and no loss. It's the point where businesses are neither making nor losing money on the bottom line. It's the moment when your business becomes self-sustaining. So in other words, the revenue that you have is enough to cover all of your costs and keep going. Maybe you can't invest in all the things you want. Maybe you can't add new marketing or sales or product development, but it's existing based on the current set of costs that you have, and it's breaking even. A thoughtful pricing strategy empowers a business to be profitable, to break even, and then go beyond that as quickly as possible. Every unit you sell beyond break even generates bottom line profit. So that's what's so exciting about this, is everything you sell beyond your break-even point goes straight to the bottom line as profit. So here is the income statement we've been talking about. And at the top, of course, you have your revenues. And then at the bottom, in the midsection in the bottom, is where you see your operations expenses. And I'm going to make this a little bigger for you to see. Okay, so at the top is your revenues, right? So up here is how much you're selling. And then you have your gross profit. So this, first you have your cost of goods sold, and in this case it's $150,000. And your revenues up above it are $500,000, and your cost of goods sold. So it costs you $150,000 to produce your sales of $500,000. And that leaves you with a gross profit of $350,000. So gross profit of $350,000, then it means you need to have, we then go down and we look at $350,000 is how much we have to cover all your other operational expenses. All right. So these expenses are things like accounting, advertising, amortization, bad debt, depreciation, employee payroll taxes, entertainment, insurance, miscellaneous, rent, software, telephone, utilities, web hosting, vehicle expenses. All those things are under your monthly or annual operating expenses. And here is where you want whatever that total expense amount, in this case for this company for the year, it's $258,000, $258,500. So that is how much gross profit you need to break even. So that's when you have enough gross profit to cover all of your expenses. And in this case, in this example, we have $350,000 of gross profit, and we have and the total expenses or break-even point is $258,500. So that means that you are above break even, and therefore your income before taxes, and this is what we're thinking about in terms of net income, is $91,500. So you are $91,500 above break even in this income statement. So I encourage you to take a look at your income statement and see, okay, where is my month to month and annual break even point? And start to be really clear about how many units did I have to sell in order to cover break even, and then to generate how many more units did I sell to create 91,500 units of gross profit, of net income. So let's go on. Today's focus is on these two core growth elements: pricing strategy and break-even point. They are one of the many core growth elements that make up the Force for Good business system. It's it's two of the legs of the flywheel, the Force for Good flywheel, which you can see right here on the screen. And we are going to use a special tool to help you define your break-even point and pricing strategy, and it's called the Pricing and Break-Even Calculator. And you can get it at forceforgood.biz/weekly-tool, weekly-tool, and it is free this week. You can download it right now, and we will then go right through the workshop and use this tool to help you identify your pricing strategy and declare your break-even point, and then take a clear high leverage habit and a high potency action to get this process ongoing. So why do you need this, right? It may be obvious, but let's just point out the obvious. Without clear pricing and break-even strategy, you risk underpricing and overworking. You can't plan, invest, or grow with clarity if you don't know your pricing strategy, you haven't defined it, and you don't know exactly what your break-even point is. And this is one of the many reasons companies stay stuck in the survival stage and never make it to high growth stage and scaling. All right. All right. So where does this fit on your 4-page growth plan? You're going to find it on the second page at the top. And this is an area we refer back to with multiple master classes and tools, because we are looking really clearly at helping you analyze each of your products, the price, the COGS, the gross profit, and then looking to see what your experience is over time with selling those products. And then over time, you will continue to come back to this analysis of pricing strategy and break-even point, so that you can keep tweaking your pricing so that it helps you navigate and grow your company with prosperity. So let's go right on into the exercise where we pull out the pricing and break-even calculator and move right through it. We're going to build your pricing model, estimate operating expenses, calculate break even, and then we're going to make some observations, analysis, and strategy so that you can go back into that section, page 2 of your 4-page growth plan, and you can make some adjustments and have some thoughtfulness about how you want to continue to grow your company. So let's start with part 1, build your pricing model. And this is where we go into the worksheet, and the worksheet emulates the same part 1. The table in part 1 is the same as the table that's at the top of the second page of your 4-page growth plan. And it's where we walk through all these elements that contribute to pricing and profitability. So the first column is where you put the name of your product. And then next you focus on unit price. This is the amount you charge the customer for 1 unit of product or service. The unit cost is the direct cost to produce or deliver 1 unit sold. Next is the unit gross margin in dollars. This is the profit earned in dollars per unit after subtracting the unit cost from unit price. So this is unit price minus unit cost is equal to unit gross margin. Next, you come across to the gross margin percent, the percentage of revenue that remains after covering unit costs. So the unit gross margin divided by the unit price times 100, and this will give you a percentage. So in the example we're showing right now on the screen, you can see that we've got 3 different products with three different levels of profitability. Gross margin of 79%, 76%, and 69%. And so we want to be able to, in your own worksheet, start to justify and clarify if that's the right percentage, if you want it to be higher or lower for any individual product or service that you offer. And that's about your pricing strategy. And so that you're generating the right amount of gross profit per unit you sell. Then we look at history. We look at the trailing 12 months, the number of units sold for each of your products. Then we look at the trailing 12 months number of customers who purchased this product or service. So you identify the numbers per product. You'll probably find that there's certain products that are more of the earlier, lower funnel items that generate more customers, but probably are less expensive, right? And then is that your more premium products probably have fewer customers. That's typically how it goes. Then you're going to look at revenue, and this is where you're going to pull the revenue directly from your income statement. You're going to say, for each product, how much revenue did I book? And this is for a particular month or a particular year. And so you want to identify how much revenue comes in from each product. And certainly it's different for each product. Some products sell more, some products sell less, some are priced higher, some are priced lower. So each one is going to have its unique revenue over the last 12 months. Then we're looking at the average revenue per customer. And this is just where you're taking the revenues from the previous column and you're dividing it by the total number of customers. And this is telling you how much per customer you were generating in revenue for each product. And this helps you really see what's what's really worth your marketing costs. Like how much are you making per customer acquisition? So every time you get a new customer over the last year for this product, this is how much you are getting in revenue. Next, you're looking at trailing 12-month COGS. So the last 12 months, how much were your COGS, your cost of goods sold? And this you want to pull also from your income statement. This isn't just a calculation of the number of units you sold times the COGS, because oftentimes you'll find that the real cost of goods is different than what you predict in the first few columns of your spreadsheet. So you really want to go to your income statement and find out what your actual COGS were for the last 12 months. Next is the TTM, trailing 12 months gross margin in dollars. So this is, again, coming directly from your income statement. It's the total gross profit for the product or service for each product or service over the last 12 months. And so this is where you're seeing, okay, regardless of how many units you're selling, regardless of what your price is or what your percentage of gross margin is, this is the contribution margin. This is how much per product you are putting into the business that's actually generating profit that then you can pay your other expenses and generate long-term profits. So this is a really important number. You want to see which products are generating the most contribution margin. And over time, you want that number to go up for all of them, certainly. And the question then becomes, well, how do I affect my price? Do I need to adjust my price to bring this on more? Do I need to bring my price up so it just creates more profit? Or do I need to bring my price down so that I can generate more sales? So it's a question, and this is why we're talking about it. And for each product, you want to have an idea of what your strategy is. The last column here is the trailing 12 months gross margin percent. And again, you want to do this calculation from your income statement, not from your predictions in the first few columns, first four columns: unit price, unit cost, gross margin, et cetera, because you really don't know what your total gross margin is per product and overall until you look at your income statement and look at it there. So it's the trailing 12 months gross margin divided by the trailing 12 months revenue, and times 100 gives you the percentage. And so again, here you can just see that there's varying amounts of contribution to the total gross profit that then can fund the operations of your business. So 79% total gross margin is coming from product one, 76% gross profit margin is coming from two, and 69% total gross margin percent is coming from product three. So you can see like what's generating the most profit percentage wise, as well as you can see in the previous category, in the previous column, the amount, the $2 million is coming from product one, 975,000 is coming from product two, 1 million is coming from product three. So now you've filled in the data on the table. And so now you have the ability to sit with that and figure out what to do with this. So you're going to begin here to consider your cost, your competitor pricing, your perceived value, and your market conditions and brand positioning. So you're going to start to think about how you might get the most out of your pricing. And do you want to make some adjustments in your table, in the first three columns? Do you want to make some adjustments so that you can change the future of your last columns? So let's go on to the next part of the pricing and break-even calculator. Part two is where we estimate operating expenses. All right, so this is part of the income statement. So I'm going to go back for a moment to the screen with the income statement. Where's my income statement? So income statement here, we're looking at the section that has expenses. So it's underneath the gross profit. So this is all the expenses that need to be covered by the gross profit we're creating by selling our products and services. And we want it to be in excess of whatever we want to make sure that our expenses are less than the gross profit that we create through sales. All right, so let's go back. All right, so here is where we are going to estimate operating expenses. And this is part of a forecasting exercise typically, but what you can do is you can look at your expense types, right? So I highly recommend you pull out your income statement and look at what's already there. So the first column of this table is asking you to list out all of your expense types. And we're going to talk about what those are in a minute. And then you're going to look at data from the past 12 months again. You're going to look at your total costs over the last 12 months. Enter the actual cost for each expense type for the last 12 months. Then you're going to look at the year one. So 1 year, going out 1 year, 1 year from today. And then you're going to look at projections for year two and year three. And along the way, you're going to make some assumptions. So we were taking the information from the last 12 months and we're predicting how much our expenses are going to be over the next 3 years. And part of this exercise is that you're thinking about, well, the last 12 months, this is what we did in terms of our expenses. And our plan is to improve this product line or invest in more marketing or whatever, or hire this new employee. And so as you start to lay out your future years, you adjust your projections for what each year will be based on the assumptions that I just mentioned as examples to what might change in the price, right? Are you planning to, buy more computers, which would be assets, but you'd have depreciation? Are you planning to hire more people? Are you planning to, is there something happening with oil prices that would affect utilities? So you make assumptions for each year on how much you think it's going to increase or decrease for a particular type of expense year over year. So, and those are these expense types are the expenses that I had mentioned before. These are the types: the rent or lease, the utilities, the salaries, benefits and payroll taxes, insurance premiums, marketing and advertising, office supplies and equipment, maintenance and repairs, travel expenses, professional fees, software subscriptions and IT support, depreciation of long-term assets, and research and development expenses for product innovation. So you want to include all of these things in your expenses, which are probably already, hopefully, in your income statement, in your chart of accounts, in your accounting software. So this is a great time to reach out to your bookkeeper or accountant. If you have a CFO, perfect. This person knows exactly what we're talking about here and can actually do most of this work for you or help you figure all this work out. But you want to look at what you've actually done over the last 12 months and then look at what you plan to do in the upcoming 3 years. All right. So then you're going to calculate in this next section of the pricing and break even calculator in part 3 is where you now can calculate break even, right? Because remember, the break even is when your operating expenses are equal to your gross profit. So now in the previous step, you just calculated for each year, last year, this coming year, and the 2 years following, what you expect your pricing, or excuse me, what you expect your costs, your operating costs to be. So that is going to help you see not just for this year or for last year, but what your break even point is going to be as the years go on, because break even is going to change, right? If your expenses change. So if your expenses are growing, then your break even point is going to have to increase to meet that level of new costs in your operating expenses. So here in this section, operating expenses are the costs associated with running a business day to day, excluding the cost of goods sold, as you can see in your income statement. And now that you have projected all of your annual expenses, you can calculate how many units of product or service you need to sell. So here we say total expenses from the last section from part 2. Write down the total expenses for the trailing 12 months along with your projected expenses for year 1, 2, and 3. Then the next thing you're going to do is you're going to go back and look for how much was your COGS, your trailing 12-month COGS, and put that in. And get the last line from in part 1, and this is the total cost of goods sold for the last 12 months, and you're going to want to calculate what it is for each of the years. And then the total units from part 1, write down the total units sold to get, and so that you put in what your total units sold was and what you project it would be in the coming years. And then you're going to have trailing 12-month cost per unit. And this is where you're going to divide up total cost of goods sold divided by trailing 12-month total units. And that's going to give you your trailing 12-month average cost per unit. So that's an important number because that's the number you're going to use to calculate break even for each month. So break even units count the number of units you need to sell of products and services based on your annual expenses. Does that make sense? So this is going to help you see how many products do I need to sell. And the other point here is that you're getting an average price per unit. So you, as we saw early on the other pages, you have pricing, you have products at different prices. And so this is going to give you a sense of how much per total sales, total units sold, if you add them all up, how many you need to actually sell. Doesn't matter which kind of product, in order to break even. So now you're going to go into part 4. And this is where you've done a ton of work to figure out your pricing, your COGS, your gross profit, your expenses, and your break-even point. So now every year for last year and for the next 3 years, you've predicted what your break-even point is going to be. And this gives you the ability then to make some predictions and make some adjustments in your pricing, should you decide to do that. So what is the product or service that has the most traction? So that's the first question that you want to observe and analyze. So write down which product or service are you selling the most number of units. And then the second is which products or services is most profitable per unit. So which products or services are generating the most dollars of gross margin every time you sell a unit. And then which products or services is generating the most profit to your business overall. So it's that contribution margin. Which product or service is generating the most trailing 12-month gross profit dollars? So this is an important product. This product is actually what's driving your profitability. It's helping you get to break even fastest, right? The others you might be selling more units, but they're not necessarily, the other products are not generating as much to your contribution margin. So take a moment and think about why that is. Is it because of the pricing? Is it because of the particular customers that buy it? What is it? Look at the numbers of customers that are buying it. Are they one-time purchases? Are they two-time, 20-time purchases? Analyze what you're seeing here on the page. What has driven results over time? So what has driven results over the last 12 months? Is there a connection between marketing efforts, sales efforts, product or service availability, pricing, competitive brands that you're fighting with at certain products? So what have been the factors and drivers of your results? Was there less attention on some, more attention on others, upsell, cross-sell? Like, what are the drivers that tell the story behind why your numbers look the way that they do? Why certain things sell a lot, why certain things sell less, why certain things contribute more gross profit. And then what is your strategy going forward? So what do you want to do now? Is there some new way you want to think about your pricing? Is there some new way you want to think about your costs? Is there a different way you want to think about how you upsell, or which products you keep, which products you don't, and how you upsell from one product to another? And what overall could you do to drive more profit? Is there some ability for you to increase price? Is there a benefit to a decreased price? Or is there a way that you can run an annual promotion on some product and create a new solution, a new level of sales? So take a moment and think about each of your products and your overall portfolio of products and where you fit in the market among your competition in terms of quality and price and ease, and and where you want, how you can grow given all of that. What are the best levers within your pricing structure and in your cost structure that can help you squeeze more juice from the orange, squeeze more profit per unit that you sell. All right, so now you have gained so much clarity. So you've discovered a lot now about your profitability, hopefully, right? So now you see what's fueling profit. You've defined where you're making and losing money. You've identified your business's true break-even point, and you've looked at it over time. You've looked at it in the past. You've looked at it in relationship to the future and what your plans are in the coming years, or the investments you want to make and how that will affect your break-even point. You've recognized what you want to scale, what you want to drop, what you want to invest in. You've looked at your pricing to see if you want to reconfigure it. You've looked at your costs to see if there's anything you can do to reshape your costs or where you want to invest cost. And all of this gives you the power to reclaim power over your growth model. And just remember, you cannot serve at your highest level while starving your business of profit. Hopefully these numbers help you really see that. So now you're going to go ahead back to your 4-page growth plan. And on that second page, at the top of the page, where you list out your products and services, this is where you want to reflect on any changes in pricing strategy that you'd like to make, and allow that pricing strategy to be reflected in these numbers. Okay, so next, we want to identify a clear habit. A high leverage habit is a weekly or monthly habit that ensures you track, assess, and refine pricing and profit. All right, so what would be a weekly or monthly habit that would keep you and your team, your leadership team, your product team, your marketing team, whoever's running all the operations expenses, with your pricing strategy and break-even point? So I would recommend highly that you review your units sold per week, every week, and calculate your way to monthly break-even. So on a monthly basis, how much is my expenses and how many products do I need to sell, or how much revenue or gross profit do I need to generate, and where am I in that calculation? So I used to think about this at Illume. I used to think about one particular product line as being my bread and butter product line, and that was the product that I focused on break even. And so I focused on how many hours do I need to book and deliver and bill and collect each month in order to break even. So we always had a certain number of hours, which is units, service units, that we needed to cover every month to break even. And so along the month, we would look every week and say, okay, how many units have we cleared this week and total this month? And where are we on our journey to break even? Where are we on our journey to making sure that all of our costs for running the business are covered every week? Second, we did a monthly review and margin review, and this is essential. It's part of a regular looking at your income statement and seeing where you are and seeing where you are in terms of break even and how you could improve your break even and how you could improve your overall profitability. I encourage you to have a quarterly pricing strategy meeting. So you could book it, put it in your calendar with all the contributors who are part of that pricing conversation, and meet together with them once a quarter, look at your data, your trailing 12 months, pull out this worksheet and look at it build the model with the trailing 12-month dollars and numbers, and find out If you are meeting your, test out your strategy that you were following and see if it's working. And if it is, great, keep going. If it's not, tweak it. You can also do a quarterly team report on top, middle, and low performing offerings and think about how you can improve each one's profitability with all the levers you can pull, whether it's, you know, uh, increasing your price or lowering cost. It also might be that there's some things you want to let go of. You want to say, you know what, we're done with this. We want to instead take our dollars that we're spending on marketing and sales and revert it to another product and we think will have better results and therefore better margins overall from that. Quicker break even. And the last thing is you want to track and review break even sales progress weekly and monthly. Until you are at break even, you need to be thinking about break even every single day. It's like it's the life force of your business is to hit break even and go beyond it. And if you're well above it, you know this because you did it, I'm sure. And now it's time to continue to look at those units sold, how many units each month, so that you can continue to increase your prosperity and also think about whatever it is you're investing in as your expenses go up or down and how you can continue to enrich the business. So you can't buy freedom with revenue alone. You earn it through profit, and profit starts with break even. So also identify a single high potency action that comes from this conversation today. What's one thing you can do this week to improve your pricing and profitability? What can you do this week to help you build to break even more quickly and then boost profitability per unit sold going forward? So you can eliminate low margin products. You can raise prices on your best sellers. You can invest in improving the most profitable offers. You can train sales team on high margin value-based pitches. You can launch a pilot offering with premium pricing. You can implement a system to track weekly and monthly break even. So I encourage you to find one core action you can take around all of this. And founders who thrive don't just know what they sell, they know what it costs, they know what it's worth, and they know what it earns. Okay, so today we did a lot. You defined your pricing strategy and your break-even point. So today you used the pricing and break-even calculator, which you can see is a perfect tool to come back to on a quarterly basis with your team and see where you are on your progress. You've integrated new pricing into the 4-page growth plan, the top of page 2. You've identified a new high leverage habit to make sure that you are looking at your profitability and your break even every single week and every single month. And you've committed to a high potency action to help you really foster this new pricing strategy into your business. So break even isn't the finish line by any means. It's the moment you take off. So next, I encourage you, as I always do, to pick up your copy of the book, A Force for Good, and you'll find more information about pricing strategy and break-even point in chapter 6. And you'll get all of the tools of the Force for Good toolkit when you buy the book. And you can find the book at aforceforgood.biz/book. If you're not already signed up, sign up for the Force for Good tool of the week. You can get it at aforceforgood.biz/weekly-tool. And this is where we send out one tool a week. It's free for 1 week. And I encourage you to consider our growth accelerator. And this is how you can really put all these tools together in the right sequence, along with the important rituals, the weekly and monthly rituals that will help you get all the way to a system of exponential growth. The growth accelerator helps you build your flywheel. So every year you can double your revenue, double your impact, and double your profit. So it's a 12 module online system, and it includes videos like this one, tools and assessments to help you craft your plan. It also involves your team, helps you connect with your team and build those rituals together of meeting, and really helps you get to the heart of what the puzzle of growth is for you, and it helps you solve for that puzzle of growth. And it's offered at a very affordable price. It starts at $599, and you can get it at a forceforgood.biz/accelerator. And thank you today for joining me and being a part of this important conversation on pricing, strategy, and break even. Hopefully, you have tucked in all kinds of kernels of wisdom and are ready to go and build a business that is both sustainable and incredibly profitable. The world is made better by women-led business, so let's all go make the world a better place.